Hi, we are the financial consultants at Sultan's Consulting, and this is our financial analysis and recommendations for Watson Brothers Venture Capital. We'll be exploring Acme Beverages Incorporated and comparing it to the industry leaders, Alternative Meals Limited. And this is our team.
Yeah, this is Johan.
Hi, I'm Fayon.
I'm Janessa.
Hi, I'm Angelina. I'll be looking after the profitability ratios. So after calculating our profitability ratio for Acme Beverages Incorporated, we can see a decline in trend over the years by a negative 2.02 regarding the profit margin. With that, comparing it to our industry leaders, AML, there is an even bigger difference in decline. Our return on assets also have a decline over the past 3 years and is not looking good comparing to the industry standards. Return on equity is greatly suffering by a negative 7.07 difference on the trend over the years and is below industry standard. This all tells us that the company Acme has struggled to maximize their profits, let alone gain anything from their assets. It also shows us that the deficit that the company is currently in regarding their return on equity. Unfortunately, their profits would not outweigh the cost, and in conclusion, does not look like much or any profit would be made by these calculations.
Okay, next, I will provide a brief overview of Acme's asset utilization ratios and liquidity ratios, which in part will have significant relevance to your short-term lending decisions. Through our analysis, we found that Acme improved its performance on accounts receivable turnover and the average collection period, which can suggest that the company is recovering cash more quickly, certainly a positive sign. This company's performance in capital assets turnover and total assets turnover are excellent, which has not only improved year by year, but also surpassed industry leader AML. However, it's worth noting a slight drop in inventory turnover can mean that potential cash is being tied up in inventory. So we need to analyze this further to see if the problem is in sales or in overstocking. Next slide, please. Now let's turn to liquidity. The current ratio has taken a little dip, but has stabilized at around 1.5, which is higher than AML. It is acceptable. However, the quick ratio is the focus of our attention, and it has fallen from 0.65 to 0.47. This sharp drop indicates a decline in the ability of current assets to cover liabilities, a signal we can't ignore, especially when it falls behind the industry standard, AML. Next slide, please.
Okay, and I will be going over the debt utilization ratios. Starting with the total liabilities to total asset ratio. The company's ratio decreased by 3.61% from 2021 to 2023. This indicates that the company improved its debt to assets position over the years, and this was likely through effective debt management or asset growth. However, the company's ratio remained higher than the industry average throughout the period analyzed, suggesting room for further improvement. While the company's ratio improved over time, it remained higher than the industry average. This indicates a need for continued efforts to optimize the company's debt structure and asset management practices. And moving on to the times interest earned ratio, the company's ratio fluctuated from 6.61 in 2021 to 8.1 in 2023. Despite the fluctuations, the company's ratio remained above the industry average of 7.15 throughout the period. In 2021, the company's net income was required to cover interest expenses at a ratio of 6.61. This indicates that the company earned $6.61 for every dollar of interest expense. In 2022, the ratio decreased to 6.32, indicating a slight decrease in the company's ability to cover interest expenses. And by 2023, the ratio increased to 8.1, signaling an improvement in the company's ability to cover those interest expenses.
Next slide, please. I'll be looking after the vertical analysis. The raw data reveals that Acme's sales have been increasing during the period 2021 to 2023. However, their net income has been decreasing overall. To put that into percentage perspective, via the use of vertical analysis, net income was 5.49% of total sales in 2021, but dropped to 3.47% in 2023. Acme is well below the industry standard AML, whose net income is 5.78% of total sales. Next slide, please. The chief contributors to this decline are cost of goods sold, advertising and promotion, depreciation, and wages and salaries. Cost of goods sold in 2021 was 62.79% of total sales, but that increased to 64.41% in 2023. Advertising and promotion rose from 4.88% of total sales in 2021 to 7.03% in 2023. Depreciation and wages and salaries has also increased as percentages of total sales. Next slide, please. From the balance sheet perspective, we can see that inventories and accounts payable have sharply increased from 2021 to 2023. Acme's inventory in 2021 was 25.66% of total assets, but rose to an alarming 40.15% in 2023. Accounts payable was 24.62% in 2021, but also rose to an alarming 32.15% in 2023. The rise in inventories and accounts payable can be explained by Acme's growth, which has influenced its investment of its working capital.
Okay, from our analysis, we have come to 3 conclusions. You can see them on the screen. Next slide, please. Firstly, I will analyze for you why short-term credit can be provided to Acme. Acme is managing its assets efficiently, better than its past performance, and also better than AML. Offering them short-term credit is a safe bet. However, everything isn't flawless. Their debt utilization ratio indicates that risks still linger. So before you lend money, you need to have a conversation with Acme about their inventory management. They should purchase only what's necessary to prevent excess, which helps you minimize the risk. Okay.
We have decided to not provide long-term credit due to their high debt utilization ratios, as they are heavily reliant on their debt.
After calculations, it is safe to say we will not be investing in shares of Acme due to their low profits and earnings.
Our presentation is over. Thank you for listening.
Thank you.
Thank
Thank
you.
you.